Hi there, everybody. It's time to get started with our webinar, and I do appreciate you being here right on time today. And thanks so much for taking time out of your weekend to be with us. Very nice to see you in our room. This is Craig at Max Trading. I'm here along with Chris and Eusebio, and we are very pleased to include you in the Max community today. By the way, this is a great trading community. It's a lot of fun, a lot of learning, and lots of assistance. For example, just this past week, I came across a trading idea within our community that gave me an extra 1,200 pips just for this past week. Beautiful. And the markets are always in a state of change, so new ideas can be very important. It was more than 4 years ago now that Eusebio began to see the need for a reliable indicator to help us deal with the changing flow of price in the markets. And he began developing and testing the MAX Enhanced Trade Format Indicator. That's a mouthful, so we just call it the ETF. It has proven itself over and over again as a very effective addition to Max Trading. And now we have added ETF, the training and the indicator, to every level of Max training. And we've done that with absolutely no increase in our tuition rates. So essentially, you get it as a bonus. This means that you can select any Max course, and you will also get the ETF indicator and learn how to use it, along with our companion bias indicator. For you, this can make a huge difference. It will give you a real shot at becoming a successful trader. I think that makes this a really exciting time to get in on the MAX system and to take that crucial step into productive trading. It may be that you really need a source of extra cash every week for yourself and your family, or you may be wanting to help out a friend or relative, or maybe there's some worthy cause that has had your attention for a while now, and you can just imagine yourself being in the position to make a real difference. Max is the place to begin turning all those things into reality, and you'll be very glad that you attended today. And by the way, I do believe it's really important that you get to see Max trading methods in real-time live price action on live charts. So I'll be sending you an invitation to attend 2 real-time trading sessions so that you can see for yourself with your own eyes the effectiveness of the MAX system and the ETF and companion indicators. You're very welcome to attend one or both, or to watch the video playback. As the developer of ETF trading, Eusebio is the perfect choice to take us into the world of Max trading today. If you've not had an opportunity to be around Eusebio, you'll discover that he is a phenomenal trader, a skilled teacher, and a person who just really enjoys helping others learn how to trade properly. Eusebio is our instructor for the ETF Standard course as well as the ETF Primer, and I just think you will appreciate his passion for helping traders become successful. So Eusebio, we really appreciate everything that you do for your fellow traders, and it's a pleasure to pass the microphone along to you.
Thank you very much, Craig, for this introduction. Hello, everyone. Welcome to this MAX presentation, and I hope you are doing fine. Before starting this presentation, let's make a quick video and audio check. Do you see my screen and do you hear me well? If you would like to type a yes or a Y in the question area so that I can see if everything goes fine. Okay. Constantine, welcome. Manu, Timothy, Jean, I hope I pronounced correctly your names, so, because you have probably realized that English is not the language I usually use. Indeed, let me tell you a few words about who I am. So I am a Belgian trader. I live in France for several years now. And I have been a Forex trader since 2000 as a part-time trader, and then a full-time Forex trader since 2008. And in 2009, after the founder of the MAX, Dr. Jim Pruitt, passed away, I have had the privilege to become a MAX instructor. So, but this was not my original career. I am a past software engineer, and I have been a services manager for around 27 years in this industry, with the last 15 years in the banking industry, which has given me the opportunity and the privilege to meet some bank traders. So, but I have also some interest in other markets. Of course, it is a long story of more than 30 years with the stock market, the options market, the futures market, and since 2000, so the Forex market. What I'm going to present today is some of the concepts of the MAX and the MAX ETF, both aspects of the MAX, and I will illustrate them with some trades example. And I will talk a little bit about money management if we have time enough. So the MAX, in fact, has been created, as I have mentioned a few moments ago, by late Dr. Jim Pruitt, named as Tiger because of a very strong temperament. And the aim of Jim was to give the traders a very powerful, reliable, but also flexible trading method. But if the MAX is based on very simple concept, it's not necessarily easy to apply. There are two keys to become successful with the MAX: work and commitment. It represents a lot of work to assimilate correctly all the concepts and all the rules of the MAX and how to apply them correctly, and so commitment. Believe me, if your only commitment is just to make money in trading, which at the end is what we would like to do, but if making money is only your only commitment, you will fail very quickly, because the efforts to accomplish in order to become successful are too much important. You need higher commitments to become successful and to sustain all the necessary efforts to become successful. But there are also other skills which are necessary to develop: patience, discipline, persistence, concentration, confidence, conviction too. You already know all these keys, so I will not elaborate more on these aspects. This is very usual on any trading method or system, because trading is not an easy task. It's really a complex task. So something which is important when we want to use a trading method, for me, it's how to define a trading method. And this is something I almost never see elsewhere. So for me, it's important, it makes sense that we have, first of all, to define what are the kinds of movement we want to catch, we want to trade, and we can call them trends, for example, because the term trends is very ambiguous. It's never really completely defined, and so we have to define what we call a trend we want to trade. We have to define when such a trend will possibly start, and we can do that by defining some setups. A setup will be a kind of pattern which can indicate if a trend is susceptible to start. Then we have to validate the different setups we may observe. And with the MAX, we have always three types of validation of every setup we have. We have what I call a technical aspect, a technical validation. The pattern must be adequate. We have a risk aspect. We have to define an appropriate risk for the trade we are taking, and in some circumstances we can tell if the risk is worthwhile or not. And then, and this is perhaps the most important but also the most difficult aspect of trading, we have to validate the setup with the global context. We have to open trades only in agreement with the global context. What do I call the global context? In fact, the global context represents all the aspects which may influence the prices in the market, whatever the market, by the way. And so for the Forex, for example, important driving factors are, and I will not be exhaustive in the list I'm going to mention, all the decisions day after day by the central banks, all the geopoliticals. It's we can simply observe for the moment the impact of any events happening in UK or in Italy or in Germany, and how these events, and I mentioned only Europe here, how these events influences the price of many pairs, and so because of they influence the currencies, in fact. And also the news release, all the macroeconomics elements which are relative to the economy of the different currencies we want to trade. And so all these elements are important to validate a setup. When a setup is in such a way validated, then we have a trade. Then we have to define also how to handle the trade. How will we progressively reduce or cancel the risk we have along the trade? As long as the trade is open, we may still have a risk until we succeed to cancel that risk and obtain a risk-free trade. Once we get a risk-free trade, then we can focus on the way to optimize the profit we can extract from the trade. Or when the risk is controlled, we can then optimize or try to optimize the profit we can extract from that trend and that trade. And then we have, of course, at some point to close a trade. And for that, we need to define how a trend can possibly exhaust. We can never say for sure when a trend will reverse or will exhaust. I prefer to say a trend is exhausting, not reversing, because an exhaustion does not necessarily imply a reversal. It may be simply a consolidation before the trend resumes. But if the consolidation lasts too long time, it's not necessary to stay in the trade. We can always reopen another trade, either in the same direction if the trend resumes, or in the opposite direction if the trend reverses. So we have to define when a trend can exhaust. And this is what we do with the MAX. What is the MAX historically speaking? So the MAX is an acronym which stands for three concepts, which are still holding nowadays. The M stands for momentum. Let me take my red spot here. It would be easier to illustrate on my slide. So the M stands for momentum. Indeed, we want to open a trade when we see also enough momentum and enough volatility, and of course under the validation of the three aspects I have previously mentioned. Then the A stands for acceleration. The acceleration here does not represent an acceleration in the price inside the trend. It represents accelerating the profits we can extract from a trend along that trade by adding to our trade in order to progressively increase the size of the position we are handling. It's by a scaling technique associated with a scale out technique that we can increase the profit we extract from a movement while we control the risk we have on that increasing position. And then the X stands for exit. At some point, I have just mentioned a moment ago the scale out technique associated with the scaling technique, but we have also at some point to close the trade with all the remaining portion of the trade we were handling. And so in that sense, the MAX is essentially a trend following method. Before we introduce the ETF aspect in the MAX, we had other ways to also trade counter-trend movement, so movement going in the opposite direction of a trend, and also some aspect of consolidation. And these aspects are described in our MAX Advanced course. We will not mention here, but I will say a few words later in this presentation. But having a technique to trade trends is not enough. We have also to use, in association with the method, a very strict trade risk management and a very strict money management technique also, in order to control the financial risk we have on the trade and how to control the growth of our trading account, or how to control a drawdown when we are facing a more challenging period. And so in that way, the MAX is applicable to any time frame, from the 1 minute time frame up to the monthly time frame, and to any financial tradable market, provided once you trade big sizes, you have enough liquidities in the market. So it is also important to understand what the MAX is not. The MAX is not a scalping technique. We are not interested to try catching just a few pips in the shortest period of time. I consider that scalping, at least for retail traders, is the most difficult way to trade the market, because we are not armed correctly to scalp the market. We have two important costs, and we have two important latency in our order executions, and so on and so on. And the MAX is not a new trading method. We don't try to catch these important spikes we have sometimes when we have a news release with a big surprise, a very big surprise, positive or negative. Because if you try to trade these spikes, you will have most of the time, if not always, very bad price execution. So, and it is not, as you can guess, so an elementary buy and sell system. We don't have just a few fixed rigid rules. We have a lot of rules. You will have an idea later in this presentation, and they are flexible because they must adapt to the market conditions. Market condition is also a very important aspect in the trading method we want to use. And so, as I have just said a moment ago, an entry setup is always defined as an opportunity which is based on technical aspect, risk conditions, and the global context. The exit setup are defined, in fact, as risk situations we have at some moment in the trade. Indeed, once we have opened a trade and at some point the price goes against the trade, this pullback, this retracement, which may become, by the way, a trend reversal, will represent a risk. And we will have at some point to consider any action to reduce that risk. And so for that, our exit setups are defined in several ways. We have several types of exit setups. Exit setup based on technical indicators. We have exit technique based on pure price action. We have exit technique based on a combination of a technical indicator and price action. We have also exit technique based on timing aspect, and we have exit technique based on movement invalidation. Once the movement we want to trade makes no longer sense, it's not necessary to stay in the trade. We have to consider to close the trade. And we can make a nuance here with movement invalidation. We can also consider a trend reversal. A trend reversal is another way also to define a movement invalidation. And so you can see that we use in some of our exit techniques indicator, but we don't use them to predict what the price can do. We do not try to predict what the price will do in the next few minutes or in the next few hours. We simply react when we quantify, and this is important to understand, when we quantify the risk we have on some moment on our trade becomes too important or may become too important, forcing us to take some action to reduce that risk or to cancel that risk. And this is where our scale-out techniques will be used, for example, as an important ingredient in the way to handle these risky situations. So, in the past, we had a classic definition of what a trend was, or what a trend is. I will illustrate in a moment what I mean. But over the years, and since 2008, 2009, 2010, we have observed some challenges in any trend following system. Due to the fact that we were observing many more often poor price action or small price movement. Or sometimes, because of the dynamic of the price or the price structure, it was frequent to miss some nice movement, and sometimes even very ample movement. And because of that specific behavior of the price reacting too fast to some events around the world, we have some inconvenience with the lag and the lack of reactivity of some of the indicators we are using, or some of the rules we are using. And there is something else in the classic way to define a trend, and consequently a counter trend. I have personally never been entirely satisfied to make a distinction between these two portions of a potential movement. You will understand in a moment what I mean, because I will illustrate with an example. And then when we use time bar chart, we lose also some details in the price movement. When we use a trend following system, we are interested in the movement the price is doing. If we lose some details in this movement, we lose some opportunities to take important actions in the way to handle the trade. And so the reason of these challenges is over years we are seeing a progressive decrease in the average daily range of all the pairs. I'm illustrating here the euro US dollar and the pound US dollar, and we can see from 2010 up to now that we have regularly important drops in the average daily range. Sometimes, of course, it increased, but very soon after an increase in the average daily range, we have an important decrease. And this is not only in the major pair, but also in the other cross pairs. And so we have to deal with it. When we have very small average daily range, then it becomes more difficult to use a trend following system. And so it was necessary to redefine the concept of what a trend is. And this is what we have made with the concept of the ETF. Now, let me illustrate with two levels we have of the MAX Primer and the MAX Standard. These are two levels of the courses we are proposing, how we define a classic trend or an ETF trend. And the aim of the ETF concept, compared to the classic way to define a trend in the MAX, is to trade many more movements and larger movement, as you will see in a moment. So let's see with some example. This is an example of a trade made last week. It was on the 24th of August. It was this week, sorry, Monday, on the pound Aussie in the 5-minute time frame. Let me explain what we have on this chart. First of all, you see here a blue aqua moving average. It is a long-term moving average, and the classical way the MAX define trends is we will consider a short trade when the price is moving below that long-term moving average we call the home base, and even the home base channel. And we will consider only long trade when the price moves above that moving average. And so clearly here we have to consider a short trade. With the MAX ETF, we introduce something else. For example, in this example, so when we use the classic MAX Primer level of the MAX, this movement was not tradable. We had no appropriate setup to trade that movement. This is one of the challenges I have mentioned previously. The price has in fact reversed too quickly, and we have not been able with the classic MAX Primer to catch a trade in that trend. With the ETF concept, we redefine a trend in a different way. We no longer use our moving averages to define what a trend is. We are only interested in the momentum we observe in the price, and we use for that this special line, which is made of a dual line or double line. You can see that that line is extremely regular. When the price is nicely trending, these two lines are parallel and very linear, and they stay well separated until we have some important pullback in the price. And even when the price is pulling back, the impact on this line is not necessarily a big impact. But it is not enough to define an ETF trend. We have what we call a companion indicator or a directional bias indicator, which is this indicator here in the bottom of the screen. We have two lines, one in green and red and one in blue and brown. The green and red line is called our slow bias or long-term bias. When this line is green, we will look for long trade. When this line is red, we will look for short trade. And you can see in this example that this portion of this slow bias nicely identified this down movement. And indeed, with this movement, we had an entry setup at this point. And so whenever we open a trade, we give to the trade a name which goes to its setup. We have several setups identifying the start of a new tradable movement. And we always consider that the trade is made of 2 units. 2 units because they will be possibly closed separately later along the movement. And we associate, of course, a stop loss. ESL means, in our jargon, an emergency stop loss. It is a stop loss based on the fact that we want to protect our account when the trade goes wrong or when the price goes violently against us and we are not able to act. For example, if we have a problem with our internet connection, this stop loss, which is a hard stop loss, will close the trade automatically when the price hit that stop loss. This is why it is called an emergency stop loss. And of course, this stop loss will be adjusted along the trade in order to control also some aspect of the trade risk. And you can see that we have, at least in the 5-minute time frame here, a rather small stop loss. So we consider when we open the trade that the trade is made of 2 units. The size of these 2 units are calculated with the concept of the position sizing in order to control the financial risk we have on the trade. For example, we can have a risk of 2% or 1% or 0.5% of our trading account. 2 units in such a way that at some point, like in this example here, when we recognize conditions, you see with this blue bar the price is going against the trade, in fact the price is retracing, we recognize a situation when some risk appears for the trade. And we have with our exit setup a way to quantify when this risk is too much important, forcing us to reduce that risk. And we reduce the risk. One of the possible action we can take to reduce that risk is we close 1 unit. An MX, which means momentum exit, consists in closing 1 unit. In this case, that unit has got a profit of 25 pips. And then later, we are left with 1 open unit. When we recognize another similar risky situation, we close the 2nd unit. And closing the trade and closing a trade is called an XXX. This is just in our jargon. And you can see that we had a first trade here, catching a total number of hits of 63 pips, 25 plus 38, representing with a stop loss of 17 pips, a reward to risk ratio of 1.85 R. R is the risk per trade. Okay, for example, if the risk is 2%, then the result of that trade is 2% times 1.85 or 3.7%. Later on the same movement, we had another entry setup on this place with a larger stop loss in this case because the volatility has increased in the meantime. And we use the same techniques. One of our exit techniques has triggered at this point. We close 1 unit, and then later another exit technique has triggered to close the 2nd unit, closing the 2nd trade with another reward to risk ratio. And so 2 trades during the European session, 2 winning trade, and you see the result of that day. You can see also on this chart, this horizontal line, this is what we call a max price level. We have another one here. It is also a max price level. These levels, we have several types of these levels, are supply and demand level. And whenever we have to open or to close a trade, we have to take into account these levels. And you can see here that this movement has exhausted not too far away from this level here, which was a good indication that our exit was not a bad exit here. We are never sure that the exit will be the best exit, but at least with this price level, we have a good exit level. So this is the movement handled with the MAX ETF primer level. But we have, in fact, the MAX ETF standard level, which is the technique with the MAX, including the scaling technique. I have made no scaling here. I'm only using scale out technique. Now, the same movement used or handled with the MAX standard, ETF or classical, gives a result which is completely different. In white here, I'm indicating the different decision made with the classic MAX standard. Remember, the classic MAX defines a trend, a short trade in a downtrend when the price is moving below our home base, which is not necessarily the case with our ETF concept. In this case, it's also the case, but it is just a coincidence because the price was already below our home base. And so with the max standard, the classic max standard, we have our entry right on this point here. It is called a short classic BO re-entry. We had one MX here, one scale-in. At this point, we add 2 units to our trade. We have a scale-out here, MX2, then another scale-out, MX3, then another scale-in, scaling number 2, an MX number 4, an MX number 5, and an XXX closing the last remaining open unit. So we have along that movement several scale-ins and scale-out, and you can see the result extracted from that movement. It was not a very important movement, and so the result was not especially impressive. So it's an average trade. But with the MAX ETF, we were able to open a trade way earlier. It seems that opening the trade, for example, with 10 or 15 pips in advance than a classic entry, this does not make a big difference, but in fact it makes a big difference. And another difference is we had the possibility to make an additional scaling. In this case, 3 scale-ins instead of 2 scale-ins. And another important difference is instead of using a 40 pips stop loss for the classic max standard, we had a smaller stop loss of only 17 pips, like in the previous example with the max ETF primer. These 3 differences make a huge difference because if you observe the different entries and exit at the end of the trade, the result was way larger, almost 3 times larger, with 323 pips, but a reward to risk ratio of 9.5 R. This is a huge difference. We have also what we call the concept of true trend. This was an example of a true trend. In the course we explain in great detail what a true trend is, but when we are in the context of a true trend, we have a probability of 25% that this true trend will exhaust, not necessarily revert, but will exhaust inside that time period, represented by this red rectangle. It's not a price level. We never know how far the price will go, but we know for sure with a probability of 75% that the trend will exhaust inside that time period. We have the lowest low of the movement here, which was right inside that red rectangle. There are a lot of things to explain about that, but this is explained in great detail in the course. And you can see also that the trend corresponds exactly to that red portion of our long-term or slow bias companion indicator. So this was a very recent example of trade, but I can show you many more examples. This is another example on the euro-US dollar. A down movement handled with either the classic max primer or the max ETF primer. We will make later the distinction between the ETF primer and the ETF standard level of the max. And you can see the different types of results we can extract from these movements through one or several trades. And with the standard level, so you can see a huge difference in the result. Higher or more elaborated is the level of the max we are using, more profit we are able to handle without necessarily increase the risk on the trade in a dimensional way, in fact. Something which is counterintuitive here is at some point in such a trend, whatever the number of scale-in you add to the trade, you are looking, in fact, more and more profits if you apply correctly the trade risk management, in fact. I have illustrated 2 examples. In the PDF you will probably receive, there are other examples, but I have illustrated example with the 5-minute time frame. Of course the max is applicable to any other time frame, and this is an example in the daily time frame. And in this daily time frame, if we consider the classic trend the max define, we can take a long trade here only with this small movement, and either with the classic max primer or the classic max standard. And we have, in fact, either a small trade because we have a small movement or no trade at all. With the max primer, it was not possible to trade that movement. But we can see that something is frustrating in this example. This up movement has started in this area. And so we need a way to be able to handle that entire movement. And this is what we have made with the ETF concept. With the ETF concept, when this happens, we are able to associate a counter trend movement with a trend continuation, as illustrated in the next slide. Let me retake my red spot here. And so here, not my red spot, not the pen. So in white, we have the different steps of the MAX ETF primer. I will not go into the detail, but you can see there were two trades with a total rework to risk ratio of 2.7R, but with the MAX ETF standard, with all the scaling and scale out technique, we have a huge increase of the profit, 7.2, almost 7.3R. We multiply the result by almost 3. And this is the big difference between the MAX primer, which does not use the scaling technique, and the MAX standard, which uses the scaling technique. The scaling technique, when used properly, is a nice way and a very powerful way to increase, importantly, the profit we extract from the trade or from the trend. Of course, I have shown here only winning trade. We don't have a 100% winning trade, of course. The winning rate of the MAX is around 70 to 75%. Depending on the market condition, it may be a little less, it may be a little more. But what is important, way more important than the winning rate, is the losing rate. We have around 10 to 15% of losing trade, but most importantly, due to the way we use the MAX, whenever we have a losing trade, the loss is always a very small one. In this example, we have a typical example of a losing trade. We had, for example, here with what we call a REMO, an entry set up to take a short trade, and immediately after, this is an experience every trader has made, immediately after the trade has been opened, the price went to the upside, so against the trade. And at this point exactly, one of our exit technique has triggered, forcing us to close one unit of the trade. And later on, before the price had a chance to reach the stop loss, another exit technique has triggered, forcing us to close the second trade. And so this trade has been a losing trade, losing 22 pips, with a rework to risk ratio which was negative, of course, not minus 46R. I have forgotten to correct my slide. The rework to risk ratio is in fact minus 0.46R. Let's say approximately minus 0.5R, half R. And this is on average the size of our losing trade, minus 0.5R. For example, if you use a risk of 2%, this means that a losing trade will make a loss of approximately 1%. If you use a 1% risk, on average a losing trade will lose 0.5%. And so very small loss, easily recoverable with a winning trade. So especially if you use the MAX ETF standard. Now I have explained that the market conditions are important to recognize how to apply correctly our entry setup, but also some of our exit techniques. And so we define what we call the price modes. The price mode consists in recognizing if the price is trending, counter-trending, if the price is in a consolidation mode, and in such a case we will have to make the distinction between a large consolidation zone or a tight one, a squeeze for example, or if the price is in a choppy mode, and we have something special we call also a spaghetti zone. What I'm going to illustrate here is a choppy mode, when the price is in a choppy behavior. When the price is completely choppy, the price behaves in a complete erratic way. In the course, we explain how to recognize as soon as possible a choppy mode or a choppy market. And fortunately, with the MAX, when we are in a choppy mode, the valid entry setup, at least with the classic MAX, are extremely rare. They are more frequent with the MAX ETF, by the nature of the movement we define with the MAX ETF, but we define also how to handle a trade in a choppy mode. And if we recognize the choppy mode, we have always the possibility to ignore a trade, because very often the price will reverse very quickly. We can see, for example, an up movement followed by a down movement of approximately the same size, and this is what we will observe. Sometimes we will have a larger movement followed with a larger retracement. Sometimes we'll see a small movement followed with a rather small movement as a retracement. But globally, we have an erratic behavior, extremely difficult to handle properly. But with the MAX, we define, if we decide to take a trade in a choppy mode, how to handle that situation in order to optimize the result we can extract from such behavior. Because in fact we never know when the price will leave the choppy mode. Here we can see that on the right side of the chart, the price leaves the choppy mode and enters into a trend mode. And this is the advantage of trading an entry setup in a choppy mode. We still have a chance to get into a trend. And if this is not the case, we explain how to handle properly such a situation. So, and this is why recognizing the price mode or the market conditions is extremely important, because they explain how an entry setup and how an exit setup must be handled correctly. We don't handle an entry setup in a trend mode exactly the same way as in a counter trend mode or in a consolidation zone mode. We have to adapt to these market conditions. So if you ignore the market condition, you will miss some important feature in the price action, and you will in fact increase the losing rate in your trading system. If you take into account these market conditions, on the contrary, you will reduce the number of losing trade you can catch. It's a way to filter some of the potential losing trades. So once you get a complete mastering of the MAX, of course, because of the performance of the MAX, I have said around 70% of winning rate, but around 3 to 5 R as we work to risk ratio with the MAX ETF standard. You can calculate, by the way, the expectancy of the MAX ETF, which is extremely positive. You can then apply what Albert Einstein was calling the eighth wonder of the world, so the compounding mechanism. And just to give you a small idea, when you get consistent in the way to apply the MAX, what kind of result you can obtain, I'm just using here this spreadsheet. By the way, this spreadsheet will be available to all the members or all the attendees in this presentation. So let's consider the following situation. Let's start with a trading capital of 10,000, for example, $10,000. And let's suppose we take a risk of 2% per trade. Personally, I prefer to take a smaller risk because I am very, very risk averse. And let's suppose, because we have, when we make some projections, we have to make some assumptions. And so let's suppose that our average emergency stop loss is around 30 pips. Sometimes it will be less, sometimes it may be a little larger, but let's consider a very conservative one of 30 pips. And let's consider we are able to make, on average, through one trade or several trades along the day, a total rework to risk ratio of 1 R. This means a total with the same stop loss, a total number of pips of 60 pips. If you divide 60 by 30, you find 2. But don't forget that each trade is made of 2 units. So 60 pips is the total number of pips made by the 2 units. And so in order to have the average result, we have to divide that number by 2, which gives 30, and then we can divide by 30, giving a 1 R rework to risk ratio. So let's suppose several other assumptions. Let's suppose you trade every day, which is not necessarily possible. Okay, so don't get me wrong. What I'm going to show you here is just an idea, a raw idea of what you can obtain. Let's suppose you trade every day. Let's suppose every day you are able to generate a 1 R profit on average. Okay, and so if you are able to do that, which is not necessarily so easy. Some days you will not trade, some days you will make more, some days you will make less, some days you will lose, of course. But if you get consistent enough, realizing that average objective, this is why I say on average, in order to double your trading account, you will need approximately 2 months. Now, the reality will be perhaps 3 months or 4 months, but you get an idea of the order of magnitude of the time necessary to grow an account to some personal objective you may have. And so you can see also the result you may obtain after 2 months, 3 months, after 1 year. You can play with the spreadsheet, and you can even consider, when you get profitable enough, some withdrawal every month. You can play with the spreadsheet, so I will not illustrate that here. So, oh, by the way, yes, in this second example, I have considered a 5% withdrawal every month, okay, a 5% of the account every month, and so you can see that at the end of in this case, the second month, 42 days is the second month, with a trading capital of $10,000, you can withdraw, in fact, almost $2,000, and your account is still almost doubling. And on the next month, you increase the withdrawal, and your account continue to grow. And so you may define, you may play with several scenarios on how you can grow an account and how you can extract some money from the market, provided, I repeat, you get consistent enough to generate these profits. And you will generate profit if you get consistent enough in applying the process of the MAX correctly. And this is what we insist with our students. Don't focus on the result, focus on the process you have to apply. Get consistent in the way to apply the process. If you are consistent in the process, the results will follow. By the way, I have mentioned the concept of true trend in a few moments ago. You need to know that on average, for each pair, you will have 2 to 3 true trends every week. This means that 2 or 3 days the price will trend enough to define what we call a true trend. This means also that 2 or 3 days of the week, the price will not get a true trend. And the big results are obtained with the true trend. When we have smaller movement, we may still have good results, smaller results, but at the end of the week, they can nicely accumulate. And so the MAX is organized in 5 different levels of courses. The MAX ETF Primer, which is, just as Chris will explain in a moment, a first taste of what the MAX may be. Then we have an intermediary level, which is called the MAX ETF Lite. And then we have our flagship course, which is the MAX ETF Standard course, with all the techniques, including the scaling and the scale-out technique. We have also an advanced course, which go deeper into some nuances we have with the MAX and which consider some more global view of the markets. But I will not elaborate too much on this. And we have the last level, which is the MAX ETF Sum, for which we abandon the time bar charts, and we can use either constant range bar chart or Renko bar chart. We have to define the range size in a very specific way, and they provide some important nuances compared to the MAX standard, but the MAX ETF Sum helps to further increase the profitability of the MAX process. So what we are proposing to you today are the MAX ETF Primer and the MAX ETF Standard. So just for me to conclude here, with the MAX, in fact, you will have a trading methodology which is based on solid, sound concept. In the different sessions, training session we explain why these concepts work, and we will focus on some very important aspect. We use indicators. Yes, we use indicators. I don't care if some other tells or explain that indicators are useless because they are lagging. Yes, they are lagging, but a lagging indicator is not necessarily a problem when we know how to use an indicator. If we use an indicator to try predicting what the market will do, yes, we fail. We don't use an indicator to predict what the market will do. We use indicators as or price action patterns as tools to pinpoint faster some potential situations. And we have two types of potential situations: trade opportunities and risky situations which call for an exit to reduce the risk we have on the trade. And attached to that, a very solid trade risk management and money management, as I have just explained. Just to give you another example, we develop in the MAX Advanced Level course, we can completely master the problem of drawdown. You need to know that even with a 70 or 80% winning rate, trading system, you may still face losing streaks. A losing streak is a succession of losing trades. You may have 1, 2, 3, 4, 5, 10 losing trades in a row. With a 70 to 80% winning rate, you will have losing streaks made of 4 to 10 losing trades in a row. And you need to live with it, because these losing trades will create drawdowns, and you need to master these drawdowns. And so we have a technique to completely master the drawdown by predefining our maximum drawdown and having the guarantee to never exceed that maximum predefined drawdown. And so this is our main priority when we trade with the MAX: always control the trade risk in order to reduce it or to completely cancel it. And so for that, we attach a lot of importance in our courses to the coaching or the mentorship approach for those who need some specific mentorship. We need a lot of importance to the homework. Each training session is ended with the assignment of a homework. We attach a lot of importance to the practice, and so after the course we have a follow-up support in terms of workshop, forums, and what Chris will define in a moment, and we call scrolling parties. So this is what I wanted to explain about the MAX. I hope you have enjoyed this presentation. If you have questions, feel free to put them in the question area. We will answer that in a moment. And now I pass the mic to Chris, who will explain some other very important aspect of the MAX. Chris?
Thanks, Eusebio. Hi everybody, I'm Chris. I'm partner with Craig and Eusebio. Just to let you know, we've trained over 2,000 people since we started back in 2008, well, when Dr. Jim Pruitt started it off. So we've been around a while, and one of the really important things with the MAX is that we ask you to do homework. This sets us aside from most other training courses. It's not just we send you out a PDF and a video and hope that you get it. We want to make sure that you do. So we ask you to do homework. I'll show you an example of that. You send it into what we call a homework group, and the instructor, Eusebio or myself, will go through it and show you where you went right and where you went wrong, sometimes on a bar-by-bar analysis of your chart. The really important thing with this is that it actually crystallizes your knowledge. It's not just something airy-fairy floating around in your head that you think, oh yeah, that's really simple. This makes you an active participant, and by sort of drawing it out on this chart, it crystallizes the training. It's, as it says there, it's not a mental exercise anymore. Here's an example of some homework. The chart on the left is just what we ask you to send in. So you mark the chart up where your entries are, where various bits and pieces are. And then the instructor will send out, Eusebio or myself will send out the reply to you to say, hey, this is good, this is bad. Have a look at doing it this way. If you want, you can freeze the video when you get this to go back over those. Those replies didn't actually match up with that chart. They were just to give you an idea on what they're like. So what we've got on offer today, here is a list of the various courses that we run, primer, standard, and then light, advanced, and SAM, the more advanced courses. Today we're just showing you what ETF primer can do, and the flagship, the standard course. And then once you've taken those, you can go on to light, advanced, and SAM. So if you're going to do the more advanced courses like advanced or SAM, then the standard is the one that you have to take. It's a prerequisite for those. The primer course is, like Xavier said, it's just an intro course. It's just to give you a taste of what we're like if somebody wanted to test us to see if we're legit or not. So it runs for a couple of weeks, only has a couple of entries, 4 now with ETF, a few exits. It's got no profit acceleration. The money management is simple but safe. It is profitable, but it takes much longer to hit goals than the standard would. You'll get to do homework and you'll be invited to forum and practice sessions afterwards, but not as many as you would have said if you had the standard. The standard, if you compare, say, for instance, a primer chart versus a standard chart, you can make an extra 30% to over 300% more profit because of our scaling techniques. And even though we're adding to the positions as the trend itself is unfolding, counterintuitively, it becomes safer. The standard requires homework as well. Well, you don't have to do it, but if you don't do it, you're kind of missing out on the course itself. We want to make sure that you actually do understand what we're talking about. And then once the course is finished, and this applies to both primer and standard, you'll be invited to the practice sessions and to the MAX forum. When we're training, we use MetaTrader as the platform to trade from because the data is free and pretty much everybody can get hold of the MetaTrader platform itself. You don't have to sign up to a broker or anything. The practice sessions occur pretty much every weekend, and depending on the level of courses that you've done, you'll be invited to most of them. Okay, I've already banged on about homework, but it is really important. It helps you understand what's going on. And as I've mentioned, we've got the after-course follow-up stuff. We're pretty sticky. We try not to go away. So once the course is finished, we hang around a lot. And if you can't do the course live, a lot of people, like about 60% of people, actually do it by videos simply because their work situation doesn't allow them to do it. So there's no problems with doing that. The homework still gets done. You can still ask questions, and some of the questions can get answered by video as well. So there's no problems with time of day or anything like that. The MAX ETF standard starts on September the 14th, so it's in a couple of weeks. Runs for 7 weeks, and it's at 3 o'clock New York City time. So like I said, live or by video. Normal price is $3,000. The webinar special is $2,399. And Craig has got some payment plans available if you want to contact him and say, hey, I want to drip feed this. Craig has also put together a package deal. So the standard course running for 7 weeks takes about 2 months. The training package using the primer course, and then the light course, which we haven't spoken much about, but essentially primer with a couple of extra entries and exits, runs for 3 weeks, and then there's the standard course for 7 weeks. So the whole thing takes about 4 months to get through. And it's up to you which ones you want to take as live sessions, or you can do them all by video or a mix and match. It just depends on how things go. That training package is available for $2,679, and it will really, really get you used to how we do things, and it will slowly get you, if you're not used to trading, it will more gently bring you into how the MAX operates and get you really embedded, or embed the information in your brain on how to use our method. So the link for that is, Craig has put it up in the chat area, max-standard-special is there. So if you, when you want it, just click on the link and take it from there, or contact Craig directly for the payment plans. This is the price for the ETF primer. Like I said, it's just 2 sessions. It's just to give somebody a taste of what we're like if they're not sure about things. It's a good course. It's profitable, but it's not as comprehensive as the standard. The price normally is $329, and the webinar special is $160, $159. And if you just wanted to do the primer and the light, then that's $759. So saving of about $300. If anybody has any questions, and we've got a couple that have popped up, we'll go through them. But so first up, platforms tend to jam on news with many brokers. Why and how do we avoid this?
Sorry, what is the question? Can you repeat the question, Chris?
Sure. Platforms tend to jam on news with many brokers. Why and how to avoid this? Why do they jam?
In fact, this happens most of the time when there is an important news release. And so the idea of the brokers is to prevent retail traders to trade during a news release, because in fact it is a protection they provide to the traders, but also to their own business. Because if the retail traders had a way to trade efficiently the news release, and in the case the broker is the liquidity provider for your trade, he may have a losing business. And so this is why, for these two reasons, so the brokers freeze the platform for some seconds or for some minutes. Now not all of them. A real ECN STP broker will not freeze the platform, but will route the orders to their liquidity providers. In such a case, there is no necessity to freeze the platform. But when the broker frees the platform, this may be, in fact, an indication that he is your counterparty when you open the trade. So it trades against you, in fact.
Okay, thanks, Eusebio. And Adenergy has asked, what's your preferred time frame?
This is a personal choice you have to define yourself. In fact, what we advise for each traders is to choose the time frame which best fits the trader's constraint. A trader is not necessarily a full-time trader. A full-time trader can use a small time frame, like for example the 5-minute time frame, the 15-minute time frame. But if the trader has another job, so perhaps a higher time frame is most suited to his needs. The 4-hour time frame, the 12-hour time frames, the daily time frame, for example. So it's up to each trader to feel comfortable and to choose the time frame fitting the time constraint of each one. Now, my personal time frame, but this is my personal time frame, I like to trade the 5-minute time frame with the MAX ETF sum, and to trade also independently the daily time frame, because this helps me to trade the macroeconomic evolution in the economies of the different countries.
Okay. I also see an email from Nelson here saying that he wasn't able to get into the webinar. So Nelson, if you're listening by video, I'm sorry you've experienced this. Not too sure what's going on. We've not seen that kind of thing before. So we'll try and sort something out, but at least we've got the videos. Okay. We have a lot of people asking how to stay consistent to keep the maximum win-loss ratio, keep a low drawdown year after year, even during unexpected financial events like black swans. So I guess the question is, how do we stay consistent, Eusebio?
This is a very interesting and important question. For me, consistency is not in the way to get regular profits or result, because you get the result the market accepts to give you, or the result you are able to take from the market. Consistency for me is to apply your trading approach correctly. And so with the MAX, you need, in fact, to be coherent with the approach of the MAX. You need to completely master the concept and the rules and to apply them correctly. This means also understanding what is your zone of comfort in terms of risk per trade, what is your global risk you can accept to take if you handle several trades simultaneously. It's important also to develop your research approach around concerning the global context. You need to understand what kind of event around the world can impact the market you are trading, and just sometimes to give an idea or to help our members, what we mention at the beginning of our news watch list is some geopolitical elements to get their attention to these elements, because sometimes when something around these points, there is an impact in the market. And so it's a hard exercise to do every day to understand the context, but you need always to develop a coherent way to trade in agreement with the global context. This is essential. So consistency is not in the type of result you can obtain, because this depends on the market conditions, but in the way you apply the max. And for that, practice is very important. So practicing until all the rules become a second nature is essential. And also another very important factor is, and this is what I do myself, even if I'm trading the max for 10 years now, every day when I trade, at the end of the day, whatever the number of trades I have made, I make a post-review of my trade. I grade my trade to pinpoint the possible errors I have made in order to correct these errors the following day, or to try to correct them the following day, because I'm not perfect. Of course, I make errors like everyone. And the improvement process is necessary to become better day after day after day. And this way you will get consistency in your trading process.
Okay, thank you. Denergy has asked another question. With the max primer, can one be profitable consistently if you master the concept? And I've replied, yes, but it's slower than the standard to actually make profit, because there's not so many entries. And it's harder to master as well, because you only get 2 weeks at it. We do provide the follow-up, but you don't get as much homework, you don't get as many examples, you don't get the detail that you do with the standard. So it is profitable, but it's harder.
Yeah, and there are less opportunities to trade with the max primer than with the max standard. Just to give you an idea, for each pair you follow from our top 10 list pair, for example, if I come back to this list here, if you follow, especially for each day of the week, the pair we mentioned, for each pair you will get between 2 and 6 trades opportunities. Now this does not mean that you will have to take all of them, but on average you will get between 2 and 6 trades, a little less with the max primer, but with the max primer you will not benefit from the scaling technique.
Okay, and thanks Eusebio. Something we've not covered is we've covered off the time frame, so we can pretty much do any time frame that you like, but what markets can we cover, Eusebio?
Oh, with the max you can trade, and yeah, you can trade any financial market. You can trade the forex, you can trade the currency contract futures in the futures market, you can trade the indices, or at least the futures contract on the indices, the commodities, for example, gold, crude oil, soybeans, whatever you want. You can trade stocks also, and if you can trade stocks, you can also trade options. The options is something special, because you need first of all to analyze the underlying stocks, and you will trade an option if you pinpoint a trend with the underlying stock. In fact, so you can trade any market you want. For example, we have been asked very regularly during our scrolling party how we can apply or can we apply the max with the cryptocurrencies. Yes, of course you can, because the cryptocurrencies are a tradable instrument. Even if personally I don't trade them, I don't like them, but the max is perfectly applicable to them. And in the max price level I produce every week in the format of all the instruments with the monthly fee, I include the Bitcoin, for example. So I calculate the max price levels for the Bitcoin. So yeah, they are applicable. The max is applicable to any tradable financial market, even the bonds market.
Thank you. Don't have many more questions coming in, but one of the main questions is sometimes it's hard to rephrase these, but I'm still in the phase of exploring trading and yet to get my feet wet. There's so much clutter with mutually contradictory information that it practically becomes impossible to get to the right information. or mentor with confidence. So my biggest question is how to get started and then survive.
Welcome to the world of trading. Indeed, in fact, there are two kinds of information you have to consider. The first kind of information is all the information or the facts that will influence the market itself. And so you need to develop that habit to analyze them, to look for them and to analyze them in order to integrate them in your understanding on the context. And then you have the world of all the mentors or teachers or gurus sometimes. So yeah, this is difficult. This is why, in fact, with the MAX, we propose this approach of the MAX ETF primer at a very, 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 very cheap price to give you an idea of who we are, if we are legit, if we are serious, if the information we provide, the education we provide is serious or not, or if it's adequate for you. Because an approach in trading, even if it is a serious one, is not necessarily adequate for you. You need also to understand through learning a trading approach, your own personality, the trading style which fits your own personality or your temperament, for example. And so, yeah, this is important. And so this is why we propose that formula of the MAX ETF primer.
And it's been kind of interesting, like following the training over the last 15 years, I guess, with myself, or maybe 20 years now. The trainings themselves are becoming more precise because people are beginning to understand more about how the markets work. So they're not as fluffy as they were in the old days when I used to jump on a site. Or even even Jim was a bit fluffy in his training. He would say, hey, look at this and look at all these pippies that I'm counting. And even though I go back to his videos these days and I know what he's supposed to be doing, I don't understand what he's talking about. So like I don't know what candle he's looking at or what the rules are, the criteria for actually getting in straight afterwards or getting out. And what we've tried to do with the MAX is become as precise as possible with this so that, that there's no discretion, that you know exactly what's going on. Having said that though, I have to put in another thing, is that the indicator patterns and the price patterns, the way the charts line up, etc., are not the most important thing with trading. The most important piece of trading is the underlying, as you Fabio keeps saying, the global conditions. So even though you might have a perfect looking setup, like a double top or a double bottom or something like that, and you're ready to go long or short or whatever, if the global bias or there's news coming up or something like that is there, it's more important than the actual price pattern or the conditions, the criteria that you've seen already. So even though you may get a moving average crossover from one place that says, yes, go for this, because there's a market open coming up within the next 10 minutes, it's not the place to be doing that. The global conditions are more important than the actual patterns that you see. So in those cases, you flick the patterns away and you wait for the global conditions to become correct or for the patterns to line up with your global conditions.
Indeed. This is a question which comes very often during our open house sessions or during our live workshop sometimes. So I explain, okay, depending on this global context, I will go short on this pair, for example. And so at some point, inevitably, someone in the room tells, now you see we have a divergence there, why not take a long trade? I say, no, this long trade is not valid, is not in agreement with the global context. I will stick to short trade because for the moment the global context has not changed. And so I know that I can miss what seems to be a good opportunity, but on a large number of trades, if you go with the global context, you will be right. In fact, you will miss some possibilities, but you will avoid many, many bad situations. So,
cool. Yeah,
now you have mentioned one of the difficulties we may have sometimes. It is the black swan, and it is fortunately these black swan do not happen very frequently. But with the rules we have, most of the time we are able to avoid them. I remember one which has been a very tremendous experience for some traders. It is when the Swiss National Bank has announced it was stopping the Swiss, the Swiss being pegged to the euro, and it happened that half an hour later there was an important news release, and we have a rule telling us that we don't enter a new trade in the last hour before a news release, or if we are in a trade, we close the trade half an hour before the news release. And so in this case, we have avoided, thanks to the rules, this black swan, because instantaneously a pair like the Euro Swiss has dropped by 800 pips or almost 1,000 pips. If you are in the opposite direction, you are bad in that trade. And so yes, we cannot avoid always all of them, and this is also why we put a lot of attention to the risk per trade. Always use a very, very small risk per trade. This means also a very small leverage per trade, because both are closely linked, in fact.
Okay, thank you. And we're kind of running out of questions here. Nobody else has really asked any except for one of them. And it's, okay, the question is, what are the best technical indicators for entry and exit points for swing trading?
For me, for swing trading, considering the appropriate time frame, it's the ETF lines and the companion indicator.
There's a bit of a setup, Eusebio.
Yeah, indeed.
I must remember that one for next time.
But again, this is not, for me, this is not an important question. It is not the point. No indicator will help you to pinpoint correctly a new trend, whatever the trading style, swing trading, momentum trading, scalping, and so on. You need, first of all, to understand why the market is moving in one direction, or why the market is reversing in into a new direction. Once you understand the why, then you can time your entry with indicators, and there are a lot of indicators. The RSI is a good indicator, the MACD is a good indicator, our ETF and bias indicators are excellent, but there are plenty of them. Never consider, in fact, this is a general rule in trading, that there is the best of something. The best never exists. What is the best today may be a nightmare tomorrow. So this is why there is no best pair to trade. There is no best time frame to trade. There is no best indicator to use. No, what is the best today may be the worst tomorrow.
Okay. Thanks, Eusebio. And we don't have any more questions, so let's wrap this thing up here. So thank you, everybody, for attending. I hope to see you in a course shortly. And thanks, Maxis, for your support again. Trade well this week. Bye now.
Bye, everyone. Thank you for your participation, and trade well.